Today is Saturday, January 9th, 2021, and I'm your host, Max Gottlich. We talk about my interpretations and insights into financial markets and the overall global macroeconomy. Well, we suffered yet another unprecedented week, most notably in Washington, D.C., but the stock market is so stretched away from reality in terms of its relative euphoric position, thanks to the Fed and central banks manipulating the Treasury market and, of course, systematically many other markets and fueling these asset bubbles to such high extents. So the dependency on QE liquidity operations and obviously fiscal support, it will continue to be extraordinarily high. I mean, prices are going higher every day, but it's not supported by any real growth, not even for any sales in most cases. Just like how the Bitcoin bubble continues to prevail as more people buy Bitcoin because other people are buying more Bitcoin. So Bitcoin goes higher because the smart money or the people who have been accumulating from way at the bottom, way before anyone else, or the dumb money, as I like to refer, they know that Bitcoin will go higher because, Bitcoin's restrictive rate of issuances relative to fiat. So it's a supply and demand imbalance, which it's very similar to how a Ponzi scheme operates. So we've gotten a lot of economic data this past week. A lot has been happening, and most notably, is the decline in non-farm payrolls and the ADP employment results reports. So which, it kind of interprets, well, not kind of, it does interpret that we are in a recession, but speculators just don't care. The yield curve is flat, and the Fed has failed many times over to normalize their balance sheet. So credit is ultimately contracting, like we've talked about, and there's no lending. So how exactly are the banks making any money? Yet most banks, most bank stocks are outperforming, right? Anyone's expectations of outperformance, it's just beat it. Simply because the Fed and new capital regulations will never let banks fail, like Lehman did, or back in '08. And obviously, prices are rising a whole lot more than headline CPI inflation, which is it kind of supports the commonly called stagflation trade, which has been talked a lot about the past couple of weeks, in an economy that is ultimately 70% consumption, right? So unfortunately, as we've seen in Georgia, the Democrats took both of the Senate seats, which really is not much of a surprise, and it's also a really major deal. Why is it a major surprise? Well, because more free money, the $2,000 checks, comes from Democrats. And why is it a surprise? Well, literally the first time since the great financial crisis of '09 that Democrats have actually taken both the White House and both houses of Congress. So it's the first time in, a decade. And now, just to note, of course, the liberals' sweep it directly affects our growing deficits in a very large way, right? Because deficits are going to be much higher because all of the expensive regulation and fiscal stimulus and government spending and higher taxes, right? That they want to pursue. And all of this means that the Federal Reserve and the banks will have to monetize this debt by printing fake dollars, which will increase the rate of inflation as it already is. And I'm referring, of course, to the asset inflation we have seen in stocks for the past decade, or so. And I know here and there they threaten to taper the size of their asset purchases, the Fed, but they never end up reducing, they only increase. So there's no such thing as tapering to the Fed, just like the debt ceiling is essentially non-existent in the Fed's eyes. And we saw this in Q4 2018, right? When this was a big quarter because this is when the Fed They wanted to taper tens of billions of dollars, but the market, they hated that. Obviously, the market dropped very significantly because, and because of this bad market reaction, literally within weeks, we saw the Fed cancel the entire program, like it was nothing, because they only care if the stock market performs well. That to their eyes is a good benchmark. And I mean, this asset bubble is insane. Just look at Tesla being a bubble of its own. I mean, it's $1 trillion company and they only have sold 500,000 cars. So do you think do the quick math, and then Bitcoin being another 2% of anonymous accounts controlling 95% of Bitcoin. So tell me that's not a search for yield inflation. Right? So for giving loans and other massive monetary stimulus, that's the reason why we see tuition inflation. So if it was not for the federal government guaranteeing these loans, there would be no lenders lending out loans to students, and students in turn would not be in massive student loan debt. So the $2 trillion in student loans is inflation in itself. In fact, I think it's even more than $2 trillion by now. That's fake fiat money, and it's inflationary because, well, obviously, because if the borrower does not pay anything he owes, then that means the lender does not get paid anything that is owed to him, which means the lender is at a loss per the borrower's gain. It's a simple trade-off. So now students have more money to spend, whatever they spend on, and the lender actually does not lose any money at all. That's why it's inflationary, because the money is actually coming directly from the printing press and, you know, directly from this printing press to the lenders. So nobody's at a loss. Everybody's at a gain except the government, because we're running massive deficits at record levels of spending, and the money supply is exacerbating at crazy highs. I'm going to mark the end of today's show here, and I am also happy to announce my investment club slash research powerhouse is finally really coming into fruition. So you should be expecting to experience a lot of our own research findings and, other content as well very, very soon. I'll be sure to update everyone when our first paper comes out. And as always, if you liked the video, please hit the like button and subscribe if you haven't already. It really helps my channel get more out there thanks to the algo. And of course, I'm not a financial advisor, and everything I say is for informational purposes only. Okay, thank you everyone, and have a good rest of your weekend.